Let's be honest, we're living in unusual times. Stocks are at record highs. Not only are they at record highs, they're at record high valuations. Stocks have literally never been more expensive, and that goes for the housing market too. Government debt is exploding, almost 40 trillion in the United States, and that's going up by almost 3 trillion a year. Interest rates have been persistently higher for longer than many people expected, and they're just not going down. Geopolitical tensions are constant. We've got Iran continuing to go on much longer than I think a lot of people thought it would. AI is creating a massive uncertainty about winners and losers. We still don't know who's going to win the game, who's going to be hurt by the game, and so there's a lot of that out there that's just really still unanswered. Take a look at this social media post. This reminds me of my childhood. How many of you remember Sears? We had at least two or three Sears near my town. They had a big catalog, a paper catalog, and Sears was known for quality, consistency, and they were the anchor to a lot of different malls. Well, this particular social media post talks about how this person worked at Sears in the early 90s. And the people that worked at Sears, whether it was in the appliance department, the shoe department, the craftsman tool department, the people that worked there could support themselves and their families, or at least that was the perception. At least that's the perception of the person that wrote the social media post. Now, he is saying that the person that ran the appliance department could support a wife and three children and could retire. These were good blue collar jobs. Everybody knew each other. And it wasn't really a job that was seen as a low level job. It was a decent job, one that you could support your family on. Now times have completely changed. I mean, Sears is no more, first of all. Secondly, retail jobs just don't provide enough income for somebody to support a family. And so, really, AI took over, the modern technology took over, and prices were pushed so high, starting in the 90s or late 90s as we started the tech bubble, and we had the first big blow off in home prices. Everything got more expensive, and it never really went back to the way it was. And so it always has to be more and more and more. And the central bank pushes more and more and more printed money into the economy because prices always have to go up now. There is no plan B. If prices don't keep going up, how are you going to pay the $40 trillion in debt, which is increasing every year? There's no way back. And so who's that affecting? It's affecting the average people. And, this is something we've talked about a lot of times, many times in the past. The wealth disparity that's been created by quantitative easing, money printing, has really been unfair. Let's look at a couple examples of what I'm talking about here with some real numbers. In 1980, in the United States, the average home cost around $47,000. I remember that because my parents bought their first house in 1978, and ironically, they paid $46,000. So this number is pretty accurate. Today in the United States, the average home is $430,000. That's a 9x increase, almost 10. So the average home price went up about 9 times, but the incomes did not go up 9 times. The average salary went from around $12,000 a year to about $60,000 a year from 1980 till now. So the nationwide average income went up 5x and the nationwide average home price went up 9 to 10x. So that's about double the pace of incomes. And so it's easy to say, well, everything costs more these days because of inflation. We accept that. But the truth is, it didn't have to be that way. The Fed made it that way. Our government made it that way by departing the gold standard. We took our currency off the gold standard. And so, average middle income couples, they both need to work, first of all, and they need to work hard. And they're getting increasingly squeezed as time goes on. I don't know what the solution is for this, but I do know it causes anger and anxiety and stress. I mean, that's really why so many people feel like they're falling behind, even when there's more dollars coming in than ever before, but they're not feeling like they're getting ahead. And so it's just it's a constant pressure. Here's another example. In 1985, there was fewer than 15 billionaires in the United States. 15. Now there's 800 billionaires. Just think about how much wealth has been created in the last 40 years. Here's the crazy part. Most people hear the word millionaire, billionaire, trillionaire so often that they stop thinking about what that actually means. It just really doesn't mean anything real to people anymore. Here's an example of what these numbers, how crazy some of these are. If you counted one number every second, a million seconds is about 11 days, a billion seconds is about 32 years, and a trillion seconds is more than 31,000 years is what it would take you to do that. That's the difference between a millionaire, a billionaire, and a trillionaire. These numbers are just unfathomable, particularly when you get up to the trillionaire level. At the same time, 37% of Americans said they would struggle to handle a major unexpected expense without stress. So risk management isn't really all about predicting the next crash because nobody can do that. It's about recognizing that we're investing in one of the most expensive financial environments we've ever seen in this country and even the world, I think. But certainly in the last 100 years, I can tell you that this is the most expensive time to invest in the United States that we've seen. So here's a problem with major mainstream financial advice. There's really just a few different angles that investment influencers or investment professionals come from. First extreme, I guess I would say, would be the doom and gloomer. The ones that say you need to panic, crashes are coming, constant fear. Now, I actually think that we are going to have some kind of big downturn in the market, but I don't think anyone can predict crashes. And I don't think anyone should panic. We're not panicked here. We're not investing in a panicked way. We're investing in a very tactical, risk managed way. So be careful of the fear mongering and those that say you have to act now, because that's almost never true. The second extreme, I guess, would be going in the other direction. These would be the passive indexers, the ones that say risk doesn't matter, or at least it doesn't matter in the way that you think it does. Don't try to time the markets, just index, put your money in the S&P 500. Valuations don't matter, and they ignore macro events. Now, I understand this because by and large, over 100 years, the market goes up, but not every time in history is the same. Right now, we're, I believe, at the most critical and extreme point that we've seen in at least 80 years. And because of that, I think it's really dangerous to take that kind of passive, kind of extreme viewpoint as well. So at New Harbor, we think there's something in the middle that makes sense. I don't think that even we can time the market. I don't think anyone can. But at the same time, I do think there's opportunities. And what we keep preaching over and over again is a more moderate exposure to risk. We're only about 48% exposed to stocks right now. We have a mindset that acknowledges where we are in the story. We know that we could have a rapid down move or an air pocket or a crash at any time. That's why we set our risk lower. Secondly, we have mental stops in place where we get out of things if we're wrong. Thirdly, we use options tactically. Sometimes, if our system tells us to, we'll use various different option strategies to smooth out the bumps in the turbulent zones. Because risk isn't just about macro news headlines. In fact, if you're investing based on headlines, you're probably late to the party and you're probably making mistakes. Risk isn't about a bad month, it's about smoothing out those bad months and good months over time and avoiding the big emotional mistakes. Volatility isn't necessarily bad. We do try to reduce volatility, but volatility can work in your favor if you're using option strategies, if you're dollar cost averaging, that kind of thing. Here's to me what risk really is mostly. First one is permanent loss of capital. You lose capital permanently, that's risk. Running out of money, buying the dip. So sometimes people might buy the dip and the dip keeps dipping, right? And so they're like, what am I going to buy the dip for with I have no more money? That's risk. So just realize things can get more extreme than you could ever imagine and then some. I've seen it. I've been doing this for almost 30 years now. Having to change your retirement plans is a big risk. Dramatically having to change your retirement plans. I hope that none of you ever have to do that because of risk that you took. That's something that we really want to help people avoid. And really, I said earlier, making the big mistakes. You have to avoid making the big mistakes. Because of psychology, many people make the wrong choice at the wrong time because they feel pressured to do it. They feel like they have to do it. The market will make you feel miserable if you overcommit. Happy to talk to you about that. And it's a big part of what we do here at New Harbor is talk about psychology. In fact, I think it's the biggest part of what we do. We understand how to apply a lot of different tools. We understand market theory and market history. We have a system, we have an investment committee. We're really good at all of the technical details, but it's also all about the psychology and maybe even more so than anything else. So we help people get through that. A lot of people delegate to us. I think that helps them. And then a lot of times we have to talk with people, talk them off the ledge, that kind of thing. You want to avoid the big mistakes. That's one of the biggest things that you can do to improve your investment results. So how do we manage risk? I mentioned a few of them already. We understand where we are in the story. We're very late in the peak of what I think is the biggest overvalued market we'll ever see in our lives. I've said that earlier. We manage things knowing that we can't time things perfectly. We have a reduced equity allocation, 48% presently. We populate that 48% with the very strongest sectors using relative strength tools. Mental stops exist. They're not stops in the market directly, they're mental stops. So if we have something that's trading at 55, we might say if it goes through 48, and particularly if it goes through there for more than a split second, if it stays there for two closes, for instance, then we will sell that position. That's called a mental stop. And lastly, options. Selling covered calls to bring income into the account and or using index puts, which is essentially insurance on the portfolio that increase rapidly in value if we have a crash. Those things help us smooth out the edges. So the biggest risks that most investors ignore are the risks that are inside of them. By and large, that is the problem. And it is not as simple as saying buy low, sell high, because a lot of times people have been taught to do things like add to winners, which in general makes some sense. But you should never buy a position, in my opinion, then add a lot more higher. Maybe you could add a little bit more. So if you bought $1,000 worth of a stock and it moved in the right direction, you might add another $300 to $500 max, another 30 to 50%. I've seen people over and over make mistakes by really increasing the positions rapidly once they start moving in the right direction, and then they get shaken out on the first correction. So the market will drive you mad. Don't let it. Have a position that you can stick with. Thanks for watching. Thanks for talking about some or thinking about some of the biggest risks that investors face. If you like what I had to say today, if you like what we here at New Harbor have to say, I would just ask that you subscribe to this channel and also click the little bell icon to get notifications. We really appreciate you watching. We try to post every single week, and we're very happy to have you in the audience. And if you have any other ideas about other videos you might like to see, please put it in the comments. Thank you.